Hey everybody, welcome to the morning market briefing. It's Wednesday, January 4th, 2022. Hope you are doing well. Hope you're enjoying the new studio. This is my first time in here. So far, so good. Feels like we're at home. It feels much more open. I'm going to throw that out there.
I don't know. I feel like it's sort of narrow through the middle. It's very definitely open this way.
Yeah, I feel much less confined.
Yeah.
I don't know if that's good or bad, but let's jump in here with some of the news, starting with Apple. Apple out of the $2 trillion market cap status, had production woes. Then how do you kind of digest this? Obviously, it makes a headline. I mean, it felt like forever we were talking about $1 trillion company coming and then a $2 trillion. How do you kind of digest where they are and what this may mean as we set up a new calendar year?
And at one point, it was a $3 trillion company. So, I mean, you've lost over $1 trillion of market capitalization on Apple. So I think the issue there is you had the production issues out of China, and now it's kind of manifested into more concerns about slowing demand. They've been talking to their suppliers about cutting further production of components. I think that this is probably true for the Macs and the iPads, but we also kind of knew this. I think the iPhone sales has actually held up fairly well, in my opinion. There's always a grain of truth in these rumors, so it's that you have to pay attention to them. Having said that, I do think that Apple is poised to hit its numbers. If they were going to miss, I think they probably would have guided down already, and maybe that's coming this week, but I doubt it. I think that would have already happened. So that's my view, and then we'll have to see what guidance is for next quarter. But right now, this is only going to serve to bring down analyst expectations for next quarter, which could allow Apple to beat expectations. But the chart looks pretty bad. The trends look less than ideal, but it's still Apple. It's going to sell more iPhones. I was thinking about this morning, though, and I think you would be foolish to think that Apple will be one of the top 3 to 5 companies by the time we all retire. And history just does not support that. When you look at the top 3 to 5 companies throughout history at any given time, they are not the top 3 to 5 companies in terms of valuation now. And so when we're thinking about Apple, just have to understand that this will not last in perpetuity, but I think their demise for now is probably overstated.
Yeah, I think it's interesting. I mean, you look at those things historically, and it's like so easy to make jokes about, whether it's a company like Kodak or, whatever. But, for all of those companies, it's like they dominated one specific thing. And you think of Apple's domination in, sure, they've tried to really push services. They've tried to push devices other than the iPhone, but it's really iPhone. I'm not real convinced that mobile devices will be the single most viable product when we retire if they don't iterate into something different, which is hard to expect that they will, just given history. They will at some point fade.
Yeah, I was going to say there's in Nassim Taleb's book, The Black Swan, he talks about the 3 biggest companies, and he puts in the footnote that he reserved the right to change the names of these companies in future editions to match, because the best thing about capitalism is that the top 3 companies will no longer be the top 3 companies in 20 years. He's like, this is how it works. Which brings us to our next topic, which is a great one, which is GE. Former massive company, the longest holdout in the Dow Jones, but no longer.
Yep, spinning out GE Healthcare. That will be trading on the NASDAQ. I think the most important aspect of this, saw this from the Milwaukee Business Journal. GE Healthcare will be the first company in the state of Wisconsin to remotely ring NASDAQ's opening bell. So,
interesting.
Yeah, big.
I didn't know.
Little trivia point.
Well, I guess it isn't a thing.
Yeah. So
I think this is going to be a very interesting business. We're going to be doing a lot of work on it here this week, pretty aggressively. Because right now it looks like the valuation is pretty attractive relative to Siemens Healthineers, which will probably be them, GE Healthcare, and Philips as the 3 biggest health technology providers to hospitals and clinics. Now that GE Healthcare is a separate entity, they have good cash flow, GE does, and I'm curious to see what the valuation is right now on the when issued market. It looks like the valuation is relatively cheap, relatively attractive. So we're really going to supercharge our efforts on the research side there and get up to speed on it.
Salesforce cutting 10% of its workforce, not necessarily a shock to see that. Some specifics on the number, it's going to be about 8,000 employees. They're also reducing their real estate footprint, rolling off between 450 and 650 million dollars in office space. That will be completed sometime in 2025. The workforce reduction, basically over the next 12 months, that they plan to get that through. And in their letter to employees, noting quite clearly that customers are taking a more measured approach to their purchasing decisions. Not necessarily surprising. I mean, we saw so much growth with so many of these companies like this when things were a little bit easier and there was, potentially extra spend to be spent, and things starting to shift a little bit there, Ben.
Yeah, I'm a couple of points on this. I think that this is symptomatic of something that we've seen elsewhere in technology where people have gotten a little bit too aggressive. You've seen this with Micron, you saw this with Amazon, now you're seeing it with Salesforce as well. But interesting that this is actually impacting them now, not 6 months ago. I think they were talking about it 6 months ago, then the co-CEO left. So there's a lot going on at Salesforce. Anecdotally, I can say I do know a person who works at Salesforce who works about 4 hours a day and makes a ton of money. And, I do worry about his future career opportunities and if he received an email today. But there are a lot of people doing very little work at that company, and there's a lot of fat that needs to be trimmed. And I think that's the right business decision, but it's going to hurt these people. And in all these letters, the CEO always comes out and says something to the effect of, I take responsibility. And that's what Mark Benioff does here. He says, we hired too many people leading into this economic downturn we're now facing, and I take responsibility for that. But responsibility without consequences is kind of nebulous and doesn't really mean anything. So I'm curious to see what he would impose as his consequence to failing and shirking his responsibility.
Well, he's probably going to take the stance of, you have no idea how hard this is for me.
Right.
That's the consequence.
Yeah. So he said, and then he continues and says, within the next hour of this letter being published, employees who are affected will receive an email letting them know. Oof. So be prepared. They're going to just send out 8,000 emails and let people go with 5 months severance. And the fact of the matter is, these tech workers, 40% of them find a job in a month, 80% of them find a job within 3 months. They get 5 months of severance of healthy pay, health insurance. They're probably going to be just fine.
Yeah.
But it's a little bit of a callous way to do it, to say, I take responsibility. Here's an email. See ya.
And check your inbox within the next hour for another.
It's a very dark lottery. Like, good news is you get 5 months pay. Bad news is that's all you get.
Yep. European inflation continuing to decelerate on the heels of Germany's lower CPI print. From yesterday, France came in at 6.7%, down from 7.1% last month. Europe, surprisingly, seems poised for a potentially softer landing. Maybe not a soft landing, but a softer landing. I did not feel like that was going to be the case 3 to 6 months ago.
Yeah, I don't think anyone did. I think the progress made on energy prices has been a real surprise for everybody. I think the grim outlook was that it was going to be a very painful winter with all of the conflict in Russia. They weren't going to have enough gas to go around, but mild temperatures, at least on that side of the ocean, has led to some significant drops in expectations in inflation, which I think could continue. I mean, unless we see a real cold snap, we've been able to avoid that. Those 13% numbers that we saw earlier this summer is predictive of what the inflation numbers would be right around this time. So, I mean, it seems like we're actually kind of cruising towards a potential for a soft landing. The question is, are the central banks going to understand that and adjust accordingly?
Ben, good write-up you sent out kind of on the state of mortgage rates, where we're seeing things go. As people are kind of thinking about the new year, the year ahead, certainly last year was dominated by inflation and Fed movements from a narrative perspective, but from an actionable human personal finance basis, arguably the biggest story was the quick, rapid hike in mortgage rates. What are we seeing right now?
Yeah, well, this is a bit of a follow-up from yesterday, and also a little bit of a preview on the macro presentation, because we'll talk a little bit about this as well. We did some work on actually where the mortgage rate should be. given where interest rates are and given where financial conditions are. And we should be in the 5.6 to 5.8% range on mortgage rates. We're right now at about 6.6%. So you've definitely seen a little bit of a dislocation on mortgage rates. The fair value, again, I would say is probably in that mid to high 5% range. And I'd anticipate anything below that needing some substantial declines in inflation expectations to get well below like 5.7, 5.6%. But where we are right now, is pricing in a little bit more conservatism in the mortgage market relative to what we're seeing elsewhere in the economy. And so people ask us oftentimes, where are rates going, where are stocks going? I'm not forecasting where rates are going, but where mortgage rates should be probably right now is about 75 basis points to a full point lower than they are.
Good deal. Lots of data coming through today, as well as tomorrow. We'll get the ISM manufacturing index today at 10 o'clock, as well as the JOLTS job openings report. We'll get Fed minutes at 2 o'clock. Tomorrow we'll get ADP employment, Constellation Brands earnings, and Ford monthly sales. Anything in particular you guys are curious to see?
I think the ISM manufacturing is going to be really critical. Right now, I think the Atlanta Fed has GDP in the fourth quarter growing at 3.7%, which would be a substantial acceleration over Q3, which I think was 3.2. And then obviously the first half of the year, which was a recession. So we've seen a substantial acceleration in the economy. We've seen a recent deceleration in inflation, and that's all good news. And I'm somewhat surprised that the stock markets have not yet appreciated that. Right now, it seems that recession is the mainstream view. Not having a strict recession would be a contrarian view. And I am curious to see how that plays out. We're not significantly changing positioning right now, and don't really have any plans to, but we are taking note of that.
Yep. Tom, anything from the Fed you think could be interesting?
Yeah, I mean, it's going to be pretty backward looking. I think there's been a lot that's changed in the last month. And I think that the minutes might scare some folks if they really read into what was said, because I think we were in a net more hawkish stance a month ago. And I think that we're sort of sliding away from that. I mean, futures are indicating that as well. You know, I don't know that the Fed is going to continue their march upward, at least based on market expectations. You know, I think that they may. I think that Jay Powell kind of is this whole time marched to his own drum, but I think that the tide is turning a little bit on the amount of hawkishness the Fed can have without the market reacting relatively violently. And so I think that they're going to have to definitely walk it back a little bit in the first couple of months, but that's just kind of my read. So I worry that the Fed minutes could cause a little bit of a gyration because they'll sound so much more hawkish than everyone feels like we need to be now, even though it's going to be looking back far enough that you're a different time period.
The job openings data that we get at 10 a.m. are really going to play a big role in that, because the big concern for the Fed is job openings are very high, which is leading to wage inflation. If those job openings come down a bit, that might be the critical number that colors and shades whatever that happens in those minutes.
That's just hard because I don't know if I trust that number at all.
I agree.
But what else do you point to? Yeah.
I mean, we're seeing inflation come down everywhere. We're seeing it here. We're seeing it overseas, and rates are indicating that we're going to have rates coming down pretty rapidly too. So at least in the short term, I think that's the direction we're headed. You know, we could obviously stumble a little bit and have to come back up, but we seem to be on a pretty strong trend right now.
Yep. Awesome. Well, we'll wrap it up there. We'll be back tomorrow morning at 8:30. Talk to you soon.